So Jody has an update for us today on the market, changes in lending, how to make more money as a real estate agent by knowing the right loan agent and having the right loan product, something like that. Is that correct?
That's right. Ready for me to get started?
Go ahead.
Okay, let me
Are you going to share? Yes.
yep.
All right. Now you're
Okay.
first sharing.
All right. Okay, so I'll just start out. We can talk about the elephant in the room, and of course, whatever questions you guys have, just put it in the chat. Um, as you know, I get questions about interest rate every day, multiple times a day, and I have some thoughts, opinions, and things like that. But one thing I wanted to talk about before I get into the rest of the presentation is something that I've noticed is happening quite a bit more now than it has in the past. And of course, it's because interest rates are on the move and they are going up. Um, just because the Fed reduced by a quarter, this morning does not mean that mortgage interest rates will go down a quarter. The Fed fund rate has an indirect impact on mortgage rates, but not a direct impact. If it did, then September's half a point drop would have resulted in significantly lower mortgage interest rates. But as you know, that is not what happened. The very next day, mortgage interest rates went up and they went up and they went up and they went up. We are almost now 100 basis points higher than where we were the day before the Fed reduced half a point in September. So even if they come down a little bit after today, which so far we haven't seen that, um, they still have they're at a much higher level to come down. And I'll show you a little chart here in the next couple of slides. So how do we deal with that with consumers worried about mortgage interest rates? They're worried about lots of things, but with specifically mortgage interest rates. Of course, education is key, and we talk about that a lot. One of my focuses, as well as Mike's, and I think that's one of the reasons we work so well together, is that we both focus on educating you so that when you're out in the world trying to do your job and helping people become homeowners or sell their home or whatever it is that they're trying to do, you've got more information than the next agent down the street that is really just focused on selling a house or helping somebody buy a house, but they don't really think about the financial impacts of it. And we can't ignore that. It is a real concern. Affordability is a real concern. And the better agent you're going to be is the one that addresses that to the consumer in your first meeting. And don't stray from it because it's scary. It is scary, but part of our job and what we do is to help educate our clients and help them make the best informed decision for their family's financial well-being. Sometimes that means right now is not the right time for you to buy, or right now is not the right time for you to sell. But there will be a time that is. And what does that look like? We can actually figure that out together, right? Me, you, and the client of yours can figure out, if not now, when. And I'm a big fan of that. I don't stray from that either. So keep that in the back of your mind as you're out there talking with people. But back to my original point, I get the question, what's your rate? What's your rate? What's your rate? What's your rate? And one of the things I'd like for any of my partner agents to do, of course, I'd love for you to start it yesterday, but definitely going into 2025, we've got to get away from just what's your rate. Just like let's take a listing agent, for example. You go to a listing presentation, is the first and only question that that potential seller that is going to ask you, what is your fee? And then you tell them, and then they say yes or no. Is that how that happens? Is it just one question, and then that's how they determine if they're going to work with you? If someone has had that happen, please raise your hand and let me know if that's common. I don't think it is. When you go to a listing presentation, of course, you're going to talk about the fees, but you're also going to talk about what is different between you and the next agent that's going to come for a listing appointment an hour later. What service do you provide? What's your level of customer, care? How knowledgeable are you? How much experience do you have? There's so much more that goes into that seller making a decision on who's going to list their property than just what's your fee. And what I'd like to challenge you guys to have in your heads going forward is that's the same with me, right? I am not just an interest rate, just like you're not just a fee. The way you negotiate contracts, how you set up the terms, whether you're, going at market price, under market price, seller concessions, no seller concessions, how are you more competitive? How do you compete with cash? Those are all different aspects of the service you bring to the table. And I am the same. So when you're recommending your clients to call me, and I know this does happen because I've had many conversations with you all, and I'm not like thinking it's horrible, but I think it will have a much better retention rate and success in our partnership if you do not say something like this. Oh, call Jody. She has really good rates. So that needs to be a scripting that we don't use anymore. It should be call Jody because she's going to take care of you. She knows exactly what she's doing. She has a lot of experience, 20 years experience. Say that. It's a little bit more than that, but just say 20. 20 years experience. I've seen so much in this industry that I think that I'm very well versed in the challenges that a borrower brings to the table. As you all know, it's very rare that you have someone that comes in with no challenge whatsoever. Easy slam dunk loan done, easy slam dunk find a house. It's not like that. There, you have to be able to embrace challenges and come up with solutions. So when I'm working with someone and the first thing they ask me is rate, I tell them, I don't know what your rate's going to be. That's individually, you might qualify for something completely different for the same property than the person next to you. So I need to find out a little bit more information. We have income-based discounts for interest rates.
Jody,
How
quick
would,
question.
oh, sure.
Hi, this is Elena. Are we supposed to be seeing slides?
No, not yet. I'm
Oh,
just
okay, never
I'm
mind.
just talking.
Okay, sorry. That's
Just
great.
just my info right now. Thank you though for asking. Um, so for example, the income-based discounts. I wouldn't know if someone qualifies until I see all of their income documentation. And there could be a half a point swing in that interest rate quote I give them. I don't ever want to overquote and I don't ever want to underquote. I want to give someone the rate that they could lock at in that very moment if they had a contract, because to me, that sets them up for more success, right? So if we're saying if I underquote you and then we find out you don't qualify for the income-based discount, not only is the borrower going to be upset, but they're going to be at a disadvantage now because maybe they don't qualify. Maybe their ratios are tight. So what I'd like to say again is just challenging you all when you're in the future, when you're referring to me, I would love it if you would steer a little bit further away from the interest rate, just because that is an ever evolving number that changes every day. Um, and it's also a number I can't control. Yes, Rocket has great rates, but you will always find a lender out there that's going to be a little bit lower. Now, you may never heard of the lender before. They may be internet based only out of some other state on the East Coast, and you may only be able to get in touch with them for 4 hours out of the day. You're going to have a good experience with that? Probably not. I get people complaining about that type of lender constantly. So let's focus more on the service that we provide our clients going forward. Please continue to refer. I appreciate it as always. And I get the opportunity to refer back to you all, I do it, when I can. All right, enough said about that. Let's move on to today's chat. So first thing we're going to talk about is our agenda. Loan limit changes for 2025. I think you guys are going to be pretty excited about this. Interest rates. I'm going to briefly talk about interest rates and what we're seeing right now in the market. I'm going to talk about our Rocket programs that I think you should focus on in 2025 because it will help you broaden your pool of clients. And then we're going to talk about the one-on-ones December 1st through the 15th that I'm currently scheduling for. Quite a number of you have signed up for that. I'm super excited about it. I think that it's going to set you up for success in the future, It'll build a stronger partnership with me as well. Loan limit changes. So this changes every year. Fannie publishes new loan limit changes for the next year about this time. Some lenders do not incorporate these changes until January 1st, and then some of us do incorporate these changes early. And Rocket, I'm happy to say, has implemented these changes now. Now, what are those changes? So this is for conforming and conforming high balance, not jumbo. We'll talk about jumbo, of course, but this is conforming and conforming high balance. The high balance piece comes into play for high cost areas like the Bay Area, down in Southern California. There are some areas of California, not very many, but there are that are not really considered high cost, but the cost of living there is much lower. You know, average home price is between 400,000 and 500,000, so that's not going to be considered a high cost area. So what that means, for example, is in this chart, one unit up to 802,650. That means anything underneath that loan amount, and this is for every county in the country, is considered conforming. Now, what's so nice about that is of all the different types of loans that you can get out there that have the best interest rates, hey, government's always going to be the lowest interest rate. But then if you don't qualify for that, you're not a veteran, FHA may not work for you because of the added cost for FHA, then conforming would work, but you would have a much better interest rate at conforming, so 802, 650 and below, than you would between conforming and where I put high cost counties. 1.203975, 1,203,975. That is the maximum conforming high balance limit. Anything over that is considered jumbo. Jumbo, you have to have reserves. Credit scores generally need to be higher. You've got more down payment. You're not going to get 10% down on a jumbo loan really anymore. If you do, the rate is going to be astronomically high. So what I like about these loan limit changes, and I've always liked it, especially where we live or I live in the Bay Area, is that means that you could buy a home as long as your loan amount doesn't go over a 1.203975. That is a 5% down loan, and generally no reserves are required. The times that I do see reserves required on those loans, it might be 1 or 2 months, and it probably is because we've got a little bit lower of a credit score, and the mortgage insurance company is going to want to see some reserves. But for the most part, no reserves required. So how does that help you in the market? It opens up your pool of buyers because maybe someone doesn't have reserves. Maybe they only have 5% down, and then that's it. Now, they may have 401ks and things like that, and we can use that for reserves. But for liquid money, 5% down, that means that, at 1.3 purchase price, you could conceivably do that for 5% down.
Are you sharing the screen right now?
It said it was, is it not?
No,
Oh, I'm sorry. Oh my goodness. Well, thank you for saying that. Here, let me try it again. Okay. Can you see it now?
no.
No, it says
There
your
it is.
screen sharing.
It
Okay.
just came.
Oh, it is? Okay, good. All right. So, back one. Okay. So let me just real quick go back. So you'll see here the units. That means a one unit is a single family home, condo, townhouse. It's just not a multifamily property. It doesn't mean it's just a single family home. It can be a different property types, manufactured homes. The 2 unit is a duplex, 3 is a triplex, 4 is a quadruplex. So these are all multifamily. So 2, 3, and 4 are multifamily homes. The 1 unit is really where the majority of home sales are, but of course there are options out there for up to 4 units. Anything over 4, 5 unit plus is considered commercial property, and you would have to have a commercial loan. So what I was saying before is the 1 unit is at 802,650. That's the new conforming loan limit. That is between 3 and 5% down. no reserves in most cases. Conforming high balance is in between 802,650 and 1.203975. In between that for a loan amount is considered high balance. High balance does carry a higher interest rate, so be prepared for that when I eventually talk with your clients about that. But if we can get to the 802,650, then of course the interest rate's a little bit better. As I mentioned before, we do have income. There are limits to the income, different tiers of it for high cost counties that they're a little bit more generous than the standard counties. But that is something that I would know if your client qualifies for after I review all of their income documentation, not just a little bit, but I have to see all of it. So in between that is the high balance, and over that amount. So if it's 1.204 and above, that's going to be considered jumbo. Reserves require generally a higher credit score, a different interest rate. It could be a little bit lower. It typically is lower than a high balance interest rate, but if someone doesn't have reserves to meet the jumbo guidelines and we have to go to the conforming high balance, then that's what you have to do. As you see on down with the multifamily, those are very generous loan amounts, all set by Fannie Mae. A quad, look at that. If you've got someone who says, hey, I want to buy a quadruplex and I'm going to live in one unit for at least 12 months, that can go owner occupied. And now the two unit is going to be a little bit more down, and 3 and 4 units are going to be a little bit more down than that. But don't worry about that right now. Let's just talk about the loan amount. So a quad, at 2.6 million, I can use 3 of the units projected income to offset that payment. That's going to be a hefty payment for owner occupied, right? But if I can use that income to offset, then this could be a potentially really good investment for someone. When you buy a multifamily home or any home, you're signing an intent to occupy for 12 months, which means you can buy another one 13 months later. So you could actually build a real estate portfolio with limited money down versus if you went to a jumbo loan, of course, you're talking about 30, 35% down for some of these. So just keep that in the back of your mind. We've talked about that a few times over the last few years that a lot of, especially the younger generations now, when they look at buying a home, they are looking at it also as investment, almost as equally as they're looking at it as a home to raise their families in, which is different than the generations before. And this might be a good recommendation if you've got someone who says, well, I don't know if this is a good investment. Well, then talk about multifamily homes. Rental income offsets the payment as they build equity. Does anyone have any questions about this chart so far? Nope. Okay, we will continue. Oh, one thing I should mention. FHA usually follows these charts as well. But with FHA, it's one thing to note is it can change based on the area that your client is in. So if you have someone that wants to buy in an area outside the Bay, and you want to run it by me, what's the limit for this particular county? Of course, you can Google it if you want. Google FHA loan limit for Contra Costa County. It's going to be the same, but I'm just giving you an example. So keep in mind that this would follow the same. And FHA, of course, is 3.5% down. VA is 100% down. Similar loan limits there, but VA actually you go up to I think 2 million even with VA. So don't be too stuck on loan limits for VA buyers if you have them.
Jody, I actually do have a question. It's
Sure.
kind of basic, but when you say loan limit, that means that it's like the maximum that you'd allow the borrower to finance. So that means that not the purchase price, that's how much you would lend.
Correct. To keep the loan in that conforming or conforming high balance loan limit, to keep them from going into the jumbo category if they
Okay.
don't qualify.
Okay. And this is for FHA or
This is for conforming conforming high balance, and for the most part FHA, but I just wanted to throw out that in some areas of California, in the whole country, but in California, FHA loan limit might be a little bit different than
Oh.
this.
Okay, got it.
Just a good rule of thumb that it follows it, but based on the area, it could change.
Okay, thank you.
You're welcome. Okay, moving on to interest rates. So, where were we this time last year? 7.6% was the average 30-year. Today, as of this morning, the average is 6.9. In early September, I was locking some loans at 5.99, 6%, 6.125, and you can see we have gone up quite a bit. The average, though, from all interest rates from 1971 to 2024, the average rate is 7.72. So I want you to write this down, take a picture of this screen, keep this in your back pocket when you're talking with people and they're giving you objections to interest rates. Yes, rates are higher right now than where we want them to be, but they're lower than where they were, and they're lower on average than where they have ever been. You can read different articles out there that will tell you that, Freddie Mac thinks interest rates the first quarter of 2025 will be, 6.25%. You'll see someone that says 5.75. You'll see someone that says 6.75. The truth is, nobody really knows for sure. We can look at trends, but there's always room for an anomaly to happen. Nobody really thought that after the Fed dropped rates, we would see mortgage rates climb as much as they have. But against some popular belief, we do have a robust economy right now. It's actually a really good economy, and inflation has come down quite a bit. However, there are still some things out there that are triggering higher interest rates. Feel free to watch Jerome Powell's statements on repeat if you'd like to learn more about it. I'm not going to get too much into that right now, but I do think that rates will start to come down. How soon? I don't think it's going to be quick. I think that it's going to take probably a year or two, maybe even into 2026 before we see rates where we really want to see them. For me, I want to see the 30-year, 4.5% to 5%. To me, that is, kind of pre-pandemic levels. That's where I'd like to see it go, but it's going to take a while to get there. Oh, I think I'm missing a slide. Oh, okay, there it is. All right. Rocket programs 2025. These are some programs and things that we do here that I want you guys to focus on in 2025 that I think will set you apart. Of course, working with me, you'll get access to all of this. We have a self-employed assist loan, and what that is a bank statement loan. No tax returns required. Just one borrower must be self-employed, Schedule C, corporation, whatever. Only bank statements. 12 months business and or personal bank statements are required. I have a calculator that I use after I review every bank statement for 12 months, and I put in all of their deposits depending on what they are, and then I can calculate using a ratio to tell us what the income is going to be that we use. And we do not require tax returns. We do not execute the tax return transcript form, the 4506T. First-time home buyers, that's what FTHB means. Eligible, 1 to 4 units eligible. Condos, of course. This is also for primary and second homes. So you've got someone who wants to buy a beach house, they're self-employed. Let's go with the bank statements. This is also good for cash out refinances. Now, we've talked about you referring refinance transactions over to me. And no, you do not get paid on that, of course. But what you are doing is getting yourself back in front of your client that maybe you haven't talked to in 6 months or a year or two and saying, hey, I remember when we closed you in March of 2023, rates were a little bit higher then. I want you to give Jody a call and see if rates are better. And if they are, and I can refinance them, what did that do? That showed them that you are still front and center, concerned about their future with home ownership and their financial stability, and that you're the expert real estate agent because you're going past just the transaction. We have the verified approval letter that we offer. once a borrower applies, I can send them through full underwriting, and we provide a verified approval letter. It's not even just where you can, yes, you can check underwritten on the contract. But what this also does is lets the seller know, and also with my phone call, that not only are they underwritten, but we've cleared the conditions. It's not that you have yes, it's always going to be approved with conditions because some of those conditions are property related, but the borrower conditions are all cleared. So there's no letter of explanation here. If there's been any gap of employment, we've addressed it. If there's been anything funky happen, it's already done. You don't have to worry about credit, income, or assets falling through. We back it with a money back guarantee that we will close this transaction for you if it has anything to do with credit, income, and assets, or we'll pay the borrower a monetary amount. But I don't think we've had to ever do that before, because this is very good underwriting. And yes, it may take a day or two to get those conditions in and cleared, but that allows you to do the 10 to 15 day close. When I tell the seller's agent that all conditions are clear from the borrower, they love that. I've had so many positive responses to that when I call a listing agent, seller's agent, once you and your client have submitted an offer. They love that, and they have a lot of confidence with that because it helps you compete same as cash. You got a cash deal, wants to close in 10 days, say, $25,000 under list price because they're like, well, it's all cash, nothing to worry about. This verified letter tells them the same thing. I can close in 10 days. Yeah, it's a loan, but the conditions are clear. Only conditions outstanding are property related. That will set you apart when you're making an offer. I guarantee it every single time I have this for a borrower, they will get that contract. I've maybe had one or two that didn't, but that was all purchase price related, not loan. No finance contingency is needed. Of course, put it in there if you'd like, but you do not need one with this letter. With FHA and VA, Rocket goes down to a 580 credit score on FHA. Now that is something that a lot of lenders would not go down to. They would have what's called an overlay, meaning that they'll take an FHA guideline and they'll say, yes, that might be your guideline, FHA, but we're not going to originate any loans under a 620 FICO score. When I worked for the banks, we had a minimum 620 on an FHA because we had an overlay. Rocket also does FHA off us refinance, meaning we don't have to be the current servicer of that loan. So if you have someone that has an FHA loan with Chase that you helped them with a year or two ago and they want to refinance, we can do that loan. Some lenders do not do off us. They only will do the FHA loans that they currently service, but we don't have that rule. We have the streamline refinance, which means no appraisal, no credit qualifying. Yes, we'll pull a credit report, but it doesn't matter what's on there unless it's, you can't be delinquent on student loans. That's pretty much a given. And if you've got, of course, you're in bankruptcy currently, then the courts wouldn't even let you do the refinance. You'd have to have court approval. So, but other issues, we're not going to worry about the credit qualifying. And of course, we're not going to get an appraisal. So if your values dipped a little bit, it's not going to impact the ability to refinance on FHA. Something that I discovered with Elena, actually, with one of her referrals over to me on a VA loan that is different from a lot of lenders is VA does not have a set debt to income ratio limit. That's what DTI means, debt to income. Rocket follows the same guideline that VA has, and we don't either. So, for example, one of Elena's clients, we had a 75% debt to income ratio. And if you've been in real estate for any length of time, you know that that's a bad number, right? Nobody's going to loan on that. But we got an approval because VA said that's fine. And we don't have an overlay that says we're not going to originate that loan. So if you've in the past had any VA buyers that their ratio went over 50, which is what a lot of the lenders have out there, they won't go over 50 no matter what. Bring them over. Let's take a look at them again, even if it's over that. Now, with that said, yes, there's probably going to be reserves required. VA is the one that will determine what that is and then let us know. But I find that out right away. When I do the underwriting report on it, it will tell me, yeah, we like this loan at 75% ratio, but we want a year's worth of payment, somewhere so that if they experience financial hardship, they can, pull from that money or that account. Of course, with a fully verified letter, that also applies to VA and FHA as well. It's not just a conforming verified approval. We will underwrite all loan types, except the bank statement loan. And I want to say that because the reason that we don't provide the verified approval for bank statement loan is every 30 days, I'll have to get a new bank statement, and that income could be greatly impacted every 30 days when a new statement comes out. So that's the only reason we don't do that. However, if we got a bank statement loan and they're under contract or they're making an offer right now, we're going to close within 30 days. We're going to know what that income is going forward, and you can still rest assured that it's going to go through. All right, back to the FHA and VA. We do also limited reviews. And please forgive me, that limited review should not be in the FHA VA box because we don't do limited review on FHA, only conforming. So if we have an FHA buyer and they look at a condo that is not already FHA approved, then we can't do the loan in there. We would have to go with a conventional loan. And if they don't qualify conventional, they would have to, look at a different condo. If they do qualify for conventional and the condo is not already Fannie Mae approved, and that happens quite a bit, we can do what's called a limited review, which we will review just that one unit. As long as the association is in good health, there's no deferred maintenance that would cause health and safety issues, then we will do a loan in there. Might be 10% down versus 5%, but that's all stuff that we'll try to figure out before you write an offer in there. The fourth piece of what we offer at Rocket that I think it's probably my favorite thing here is credit upgrade. And I use this on just about every single borrower that I have. Even if they have a good credit score, we think we can improve that to get them a better interest rate, and that's the only reason, then we'll put them through credit upgrade. Minimum FICO to go in the program is 560. They receive a dedicated concierge, one representative that's going to walk them through the entire process, start to finish. There's no fee for this. Very quick turnaround time. It's between 24 and 48 hours that they receive the first phone call. We do a rapid rescore. For example, if I've got somebody at a 620 and credit upgrade team reviews their credit and says, I think that if they do this or this, we can get a 640, and the borrower agrees, then they go through and do the steps that credit upgrade gives them, and then we rapid rescore them. They can do that while we have a loan in process, while they are under contract. Even if it's just to help them get a better interest rate, we will do it. If they can't get a better interest rate, maybe we don't get enough points, or maybe they qualify for our income-based discounts and it doesn't matter what their credit score is, it will help them with mortgage insurance. So it's still a great program to use. You can correct me if you know of a lender out there that does it. I personally don't. I've got a bunch of friends, of course, up here that work at various lenders, and some of their lenders, I know the place I used to work at a credit union does not even allow you to re-pull a credit report after the initial pull for 90 days. No matter if they say, well, I paid off a bunch of debt, my score should be higher. You cannot pull a new report. Rocket not only allows it, we encourage it. My management team encourages me to put everybody through credit upgrade because we want to put the buyers and borrowers in the best position possible to create long-term success with being a homeowner. Oh, was that it? I had one more slide. Aha, let me reshare. Do you see just the Zoom on the screen now?
Yes.
Oh, okay. I must have clicked too fast. I'm just going to talk about real quick the planning for success for 2025 with the one-on-ones that I briefly mentioned at the beginning of the call. Like I said, several people have signed up and I'm super excited about it. What we're going to do is it's going to be about 30 minutes Zoom call. What I'd like for you to do is email me at least 3 preferred days and times that you have available, that if I have that availability on my calendar, I'm going to go ahead and confirm it and send you the Zoom or the invitation to mark yourself off for that time. We're going to talk about 2024 goals. Did you reach them? If not, why not? If you did, what contributed to that? Did a lender help you reach your goals? Was it me? Was it not? What was your experience like? Do you have your 2025 goals written down? If you don't, let's come up with some. If it's not written down, it's probably not going to happen, right? And I know this kind of coincides with what Mike is going to do with you all, but this is going to be more kind of our partnership together, and how you and I can help each other grow our business, but most importantly, help everyone home, right? That's my motto. That's Rocket's motto. And I live by it. Please sign up, send me the email, and we'll get you booked as soon as possible. And that's what I have for today. I'll stop sharing my screen now, Mike, and then if you want to take it over for any questions, comments, critiques, anything.
Do we have any questions?
Oh, bridge loans, JD. Had a customer mention they had one approved so they could buy before selling their home. Yes, a bridge loan. So bridge loans basically where you're going to take out equity of the current home you own. Maybe you've got it for sale. It's not sold yet, but you want to close on the new home, but all your down payment money is tied up in this property. And so you want to take out some of that money. It's basically a bridge from this property to the next. And then you would pay it off with the sale of that previous home. There would be a lien attached to that property. So if you took out, say, $25 or $250,000 to put down on a new home, the lender is going to put a lien on that departing residence, what we'll call it, so that when that sells, that bridge loan is paid off. Typically, much higher interest rate. You would have to find out from the varying lenders out there that offer these. Are there any prepayment penalties? In theory, there shouldn't be, but always read the fine print. One of the things that I would recommend as opposed to a bridge loan that Rocket offers is a home equity loan. We do not have any prepayment penalty. It goes up to $500,000. Yes, it would be paid off if they sell the home. If they end up not selling the home, then they keep that loan. There's no requirement that it has to be paid off in any amount of time. So we're not going to say, here's your loan, it's good for 3 months. After that, it's a balloon paid off. So if you have any questions or think that might be of interest to you and your clients, let me know. It is not called a bridge loan here. It's called a home equity loan, not line of credit. So they're not drawing off of it. They're going to take a lump sum, and it's a fixed rate loan. Did that answer your question, JD? If not, feel free to
Yes, it
ask
sure
again.
did. Thank you,
Oh,
Jody.
great. You're welcome. Emily, you said it just went down today. I'm assuming you're talking about the Fed fund rate. Yes, it went down 1/4. I think I said in the beginning of the call that's not directly impacted with mortgage rates. So we don't see mortgage rates go down 1/4. It really a lot of other influences to mortgage rates. One is the 10-year Treasury. If you look at that, then you'll see well, interest rates have gone up quite a bit
Yeah,
since that initial
actually,
drop.
I heard that real estate mortgage interest rates went up. So how is that
Yes.
possible? Is that possible?
Yes, it is possible because it's not
Oh,
tied to the Fed fund rate.
okay.
So,
Thank you.
but a lot of consumers think it is, and that's why I think I mentioned a couple of weeks ago, I had a lot of people ready to refinance in September. And I mean, I had people with $300-$400 a month savings, and they were, nope, I'm going to wait until the Fed drops. And I say, please don't do that. That is not a direct impact. But nevertheless, they waited. The very next day, rates went up, and they've gone up, like I said, about 100 basis points. None of those people can refinance now because all that savings is gone. So now we have to wait. So
I
just
do
be
have a
careful not to follow them.
question.
Yeah, sure.
Do you work with investors, like for people that want to invest in the house, not necessarily live in the house?
Sure. Investment property.
Yeah.
Yeah, absolutely.
Okay. What's the criteria for somebody that wants to do that?
It all depends on the property type, the loan
Mhm.
amount.
Uh-huh.
it varies. It's similar to the type of requirements even for owner occupied.
Mhm.
However, with investment property, you're going to look at more money down
Okay.
and higher interest rates.
Okay. And is there a maximum head count as to like how many people can be investing in that same mortgage, or how does that?
Yeah, sure. So for a residential mortgage, there can be no more than 5 loan applications. So a loan application is typically 2 people. And if you say 2 times 5, well, that's 10. Now, very not really going to see that though, not in the residential world. The
Mhm.
most I've ever had in, my 20-ish years or so in this industry, the most I've ever had on a loan was 6 people.
Okay.
So is that how many people are you thinking of?
3.
Oh, no problem.
Okay.
Yeah.
Thank you so much.
Okay, you're welcome.
Jody, this is Monica. I
Hi,
just want to
Monica.
say thank you so much for this information. This really, really helped us. So I appreciate that. And I'm sorry I missed the memo about being an avatar today.
Yeah.
You guys are so cute.
Well, I had a little dental procedure, so I'm looking kind of rough. So I thought it would be best on everyone's eyes if they saw an avatar versus my swollen jaw.
So cute. But
Michael and I are doing this out of sympathy for her.
Yes, they're standing in solidarity with me.
That's
Thank you so
exactly it.
much.
Solidarity.
very nice. Very nice.
I
Thank you for the
appreciate
info.
it.
Very
You're
useful.
welcome.
Jody, I have a quick question for you. So,
Yeah.
obviously, I know you don't have a crystal ball and you don't know, what's going to go up, down, sideways. But if we're looking at it from a, short term and long, I guess midterm kind of standpoint. So the initial thought was that, with all of the pent up demand prior to the election, that, a lot of buyers were saying that they were pretty much going to hop into the market after the election. How much do you see the raising interest rates affecting that? Do you think people will still hop in? Do you think people will now be resistant as rates are going up? Or kind of what do you think that's going to look like? And then I know often with things like this, there's sometimes like a 75-day to 90-day bounce back. And just curious kind of what your thoughts were on the outlook of things overall.
Sure. Great question, Michael. I do have thoughts. I said it before the election, depending on which candidate won, we're potentially going to see higher inflation, higher mortgage interest rates. And unfortunately, I think that's what's going to happen. I don't have a crystal ball, of course, like you said, but just reading the policies, of course, they're not implemented yet. Will they be implemented? It's very likely, but who really knows what's going to happen? The tariffs are a big concern. I think that if those get implemented, we're going to have it's going to be, higher inflation than it is now. We're going to definitely have affordability issues creep back up. As you could see, the market with interest rates going up before the election, investors were already baking in what they thought a Trump presidency would look like to the market. And that's in 100 different articles out there. So that's not my sentiment. That's what investors that, do all this, Wall Street and all that, that's what they were saying. And so they were putting that in. And then of course that's what happened. So that's a good indicator right now that, yeah, that's what we're going to expect is higher rates and definitely going to have pushback. I think that borrowers are still concerned about affordability, but that's why I showed that slide that even at 6.9, we are lower now than we were this time last year. We were 7.6. Now this is the average conforming 30-year. So that remember the 802 loan amount and under, and this is nationwide. So it's not exactly what the interest rate would be right now if I locked somebody, close, but there's all different ways that you could get a higher or lower interest rate. So I would say when you get that concern from people that, oh, now I'm going to wait. Well, the waiting game, it can be a very long game to play, right? If you were waiting when rates started to come up in 2022, what, March, April-ish. We are going to be 3 years from that in just a few months, and you're still waiting. Meanwhile, correct me if I'm wrong, but in the state of California, and it may vary from different, areas, but landlords can increase rent up to 10%. Now, do they? I don't know, but they could. So that's a significant increase in cost per month, whereas a 30-year fixed loan is going to give you a set payment. No matter what happens out there in the market, this is your payment. When rates go down, you can always refinance, and I help with those costs when you close your purchase with me. So, when you're having those conversations, just try to encourage them. If you can afford to buy, it's a good time to buy. It doesn't matter what the interest rate is. If you can afford it, it's a good time to buy, no matter what's going on in the economy. The key is if you can afford it, then you should do it.
And
Appreciate
talking about refinancing, what's the average rule of thumb for the amount of interest rate change that makes it worth it to refinance? So obviously, if you change by, 0.25%, when you add in all the fees and everything, typically it wouldn't be worth it. What's like a general rule of thumb of like the interest rate difference that makes it worth it to refinance?
Great question. So when people ask me that, I say, well, there is no rule of thumb, and here's why. If you have a $200,000 loan, a quarter of a point, even a half a point might not do very much for you at all. If you've got an $800,000 loan, a half a point or a quarter of a point might be significant. So I don't really look at it as there's a rule of thumb that if it's this, then you should do it. I look at, excuse me, I look at specific. So I don't really work much in hypotheticals in my job because obviously I do a lot of math, and math is, certain. So I will say if this refinance will save you $250 a month, it's going to cost you $1,000 to refinance. Does that make sense to do it? Absolutely. If I can cover the closing cost and it's an immediate benefit, you should do it right now. Secure that savings now. You make 4 payments. That's all you have to make on this new loan before you can qualify to refinance again. The reason it's 4 payments, roughly 6 months because of the skipping the month, is because lenders are not allowed to churn. We're not allowed to just take one loan and then refinance it and refinance, over and over and over and over many times a year. So really, you can refinance about 2 times a year. But it is kind of a ratio. If I'm not paying a closing cost, maybe you want a super low interest rate. Maybe you want to buy the rate down and just be done with it. And it takes you 3 years to recover the cost of refinancing. It's an individual decision. So, if you've got right now a 6.5% interest rate, you're not refinancing. Let's see when it gets to 6.25, maybe 6, and then we can do some math. If you've got a $2 million loan, a quarter is going to be significant. Does that make sense?
It does, definitely. I'm kind of looking at it from the standpoint of like, how would I walk a client through the journey and their expectations? Looking at what it is now, then obviously, it's very early and we're still only a couple days into this. So I think it's
Sure.
going to be at least a couple days more to kind of see how things,
Yeah.
flush out. But I think
Michael,
it'd be helpful to have that conversation with them, saying, this is the house. This is the house of your dreams. We're going to go in on it, and then give them kind of an expectation for what that journey looks like. I think that, refinance a couple of times a year information is helpful because most people don't think about that. Even people who do refinance, I see a lot of times, do it once. So knowing that they have that ability to, kind of follow the rate and have it be affordable to be able to refinance, I think would give them some sort of peace of mind and help drive the buying behavior.
that's a good point. And what I would say if you want to do that on your own is just pull up a mortgage calculator or 30-year amortization schedule, and probably mortgage calculator, and then change the rate by a 0.125%. So you would start at, let's say they close at 6.5. You can give them a little chart that says for each 1/8 of a point reduction in your rate, this is how much it is in your payment. For example, I did this for someone, it was like a little over $1 million loan recently, and every eighth of a point difference in his rate was $96 a month. So if his average closing cost is 3 grand, but I can help with that and it's zero, then, you know, a couple of months, or I'm sorry, a couple of, rate reductions, say from 6.5 to 6.25, a little under $200, but take the savings now and refinance later when it drops a little bit more. It really depends on the individual. But if you want to provide that, just run a mortgage calculator and let them know each eighth of a point that it goes down, this is what your savings would be. In the very beginning of the loan, of course, most of their payment is going to interest, not principal. So it would be a pretty safe bet to just use their loan balance, knowing they're going to pay it down a little bit each month, but it's not as significant until later years in the mortgage. But that would be a really good idea.
Okay, and then also correct me if I'm wrong, but based on the rate of appreciation, if they wait too long, it's still by, the cost of the loan and what they end up paying, it's gonna be more anyway, right? Like if your house, if the house appreciates by 10%, but you're looking at X, what's kind of the break even point for that?
Well, so when I'm looking at refinancing, I really don't take appreciation into consideration at all. I'm just looking at what is your new monthly payment? What's the interest savings? Did you have to pay for this refinance? If you did, how much was it? And how long after you've paid that refinance cost, how long until you actually are benefiting from having refinanced, right? So if it costs you $1,000 and you're saving, $50 a month, how long does it take you to, saving that $50, does it take you to then pass the $1,000 mark and then start actually benefiting? So that's how I look at it with refinances. I'm not
Yeah,
really looking
definitely.
at
So
depreciation.
my question is actually really like purchase now versus appreciation. So like say that let's just use 7%. Say the rate is at 7% right now. And the house costs $800,000. But if you were to, wait until next year, it might be 1/4% less, but now it's $850,000. So wouldn't it a lot of the times if they I'm saying if they wait too long, wouldn't the appreciation then really price extra money into their loan anyway?
Oh, I think I understand what you're saying. So if I'm understanding correctly, you're saying that if you wait too long, that's missed appreciation.
Yes.
And even with the interest rates where it is, 7%, if you refinance at 6.5 this time next year, you still have not only that interest savings that will start then, but also the appreciation in value. Is that what you're saying?
Yes,
Yeah.
exactly.
Yeah, that's a very good point. I would make that point every single time I talk to prospective buyers. I think they're estimating in California about 4%, 4.1% appreciation. Of course, there's going to be pockets that's more, there's going to be pockets that's less. Um, I usually use 3% on $1 million loan, $30,000 in appreciation every year. In addition to the your taxable income is reduced by your mortgage interest. Consult with your CPA. I have to say that because I'm not one. But I know that my taxes last year, I got a really nice, help with my taxes. And it made me able to stomach my mortgage payment just a little bit better because instead of paying that to the IRS, that's just kind of equity back in my pocket. So there's several different ways you can look at that. Of course, the interest deduction, the appreciation, and the ability to refinance, when rates and as rates go down. So another reason not to focus so much on interest rate at the time of purchase right now. Let's just get the property. Now you're going to pay it in rate or purchase price, right? As people are on the sidelines, you're going to pay it in rate. As people jump off the sidelines into the game, you're going to pay it in purchase price. More competition, more buyers, less property, higher purchase price. Simple mathematics.
Awesome. Thanks, Jody.
You're welcome. Any other questions? I don't see any.
You don't need an avatar to ask a question, in case you're wondering.
That was helpful, Jody. Thank you so much.
You're welcome. And remember, pull me in anytime you want. You've got someone that's, you feel like you're kind of hitting a wall and it's not making sense to them. Not that you're not explaining it correctly, but if they're just not absorbing the information, pull me in and say, hey, I want to have a consultation with this buyer. Here are the numbers. Can you prepare something for them? And then we'll have a quick little Zoom call, whatever you want. I am your partner I'm here to help support you. Okay. I don't expect you all to know everything about mortgage lending. I want you to know just enough, I say, to be dangerous, to get your phone ringing, right? So don't hesitate to call anytime.
Thank you.
Thank you so much.
Thank you all. Mike, anything else you want to talk about or?
No, we're going to be sending out a notice next week. We're doing business planning as well. Tuesdays and Thursdays, same time, same place. Don't miss it. That's all I got. All right.
Thank you.
Thank
Have a great
you.
day.
Bye, everybody.
Have a good day, everyone. Thank you.